What's the difference between a balanced and a growth mutual fund? So let's take a look at the risk-return pyramid, where the higher up the pyramid you go, the greater the risk, but the greater the potential return. Balanced mutual funds fall in level 3, growth mutual funds fall in level 4. A mutual fund is a financial vehicle made up of a pool of money from many investors to invest in assets like stocks, bonds, money market instruments, and other assets. So here's how they work. Many investors pool their money into the investment company. There's a fund manager that has an objective for that fund, in this case, a balanced fund. He then or she then creates an allocation to serve that objective. In the case of a balanced fund, we're looking for the objective of capital appreciation as well as income as well as safety. And so in that situation, we're going to have about a 50-50 stock bond mix or somewhere there similar. So here's how you get paid. In a balanced fund, the objective is both income and growth. So on the stocks held in your fund, you're going to earn dividends. On the bonds held in your fund, you're going to earn interest. On the stocks that are in your fund that are not sold, you're going to get capital appreciation. And on the stocks that are in your fund that are sold, you're going to get capital gains. So the pros of a balanced mutual fund is they're diversified, there's lower risk, there's lower expenses, and typically less volatility. Some of the cons are your allocations are fixed, they're not really suited for tax shielding. You're going to get safe but lower returns, and you don't really have immediate liquidity, is that you have to wait till the end of the day in order to close out the position. So in the case of a growth mutual fund, that fund manager has a different objective for the fund, in this case growth. Growth means capital appreciation. That means companies are reinvesting their profits back into the growth of the company. A growth company is going to have a higher allocation of stocks and bonds, and those stocks are going to be companies, again, set to growth. The top two pros is you get increased growth and you have diversification. The cons are that it's higher risk, you have to leave your money in for a longer period of time, and there's more volatility. Balanced mutual funds will return on average between 8 and 12% per year, whereas you'll get much higher returns for growth-oriented funds. Everyone's financial situation is different. To find out which funds are best for you, schedule a one-on-one planning session. My name's Scott McLean. It's not what you make, it's what you do with what you make.